and it's the leading report on cutting-edge financial market and business policy issues. And this year, the theme is sustainable and resilient finance. And obviously, it was already something on the front of mind of many regulators and investors and policymakers, but has taken on a new urgency by the COVID-19 pandemic. We are joined today by many distinguished speakers to delve into the Outlook's findings and recommendations in detail. What we're going to do is open with the OECD Secretary-General, Angel Gurria, followed by an address by Switzerland's Deputy State Secretary for International Finance, Stefan Flückiger. I'll then present the findings and we'll move to our panel of experts for discussion, moderated by Anthony Curry of Reuters Breaking Views, and then opened by Sergio Marti, the Group Chief Executive of UBS. So to kick off the panel, please join me in welcoming the Secretary-General of the OECD, Angel Gurria.
Thank you, Greg, and thank you, dear friends, for joining us today. Ministers, ambassadors, ladies and gentlemen, dear friends, welcome to the launch of the OECD's 2020 Business and Finance Outlook. This year's Outlook, as Greg mentioned, focuses on sustainable and resilient finance. Since our work on this report began, the world suffered the health and economic crisis of a magnitude not seen in our lifetimes. Global output dropped sharply in the first half of 2020 as the pandemic took hold. And despite a partial recovery in the second half, we expect the global GDP to decline by about 4.5% this year. I have to say that is better than the number we put out last June, where we said it's going to be -6. And in case of a second wave, it's going to be -7.5 or 7.6, all negative. Now, we are looking at a better number, -4.5. Still a sea of red everywhere, still very negative, and still a situation where the rebound in 2021 will not be enough to get us above the level where we were in 2019, with very few exceptions. The shock has highlighted the gaps in resilience and in sustainable practices that are afflicting our economies, including in our health systems, our global value chains, and our financial markets. Now, as we look to the recovery, it is clear that we have both an opportunity and a duty, and I say a duty, to build back better. We can and we must tackle both the short-term urgency of the pandemic and the pressing longer-term global challenges. Many governments are mobilizing public resources in support of a green, sustainable recovery, and sometimes in an impressive scale. This is welcome, just as it is necessary. But finance also has a critical role to play, as large flows of private capital will need to be directed to new sectors, new activities in the face of the current and upcoming economic realities. The good news is that finance is increasingly able to play that role. Institutional investors with over $30 trillion of assets under management have pledged to use forms of ESG investing in a long-term, better aligned portfolios that will take consideration of environmental and social factors with environmental and social values. Also, due to the mainstreaming of ESG in a number of products, ESG funds have received over $1 trillion of inflows. So all that is good. Moreover, there's been growing pressure from stakeholders for greater consideration of sustainability. At the same time, firms and regulators have become increasingly aware that factors like climate change represent material, non-financial risks over the long term. And therefore, there has been a push to give such risks greater weight, greater consideration in their decision-making. This is helping to raise the horizon for corporate strategies beyond the next quarter earnings report. Now, progress has been hindered, however, this is the however part, by the lack of agreed definitions and adequate disclosures, and by the lack of agreed data. As we often say at the OECD, if you can't measure it, you can't manage it. And here the question is, what is it that we're trying to measure? This outlook asks a critical question. Are actors in financial markets, be they institutional investors, boards, household savers, lenders, or infrastructure financiers, are they getting the information they need to properly consider ESG factors when they make investment decisions? Unfortunately, the answer is often no, they're not. Despite the proliferation of ESG data and tools, ESG performance is still difficult when we're trying to compare between companies, between projects, between financial products. End users are still getting a fragmented and inconsistent view of ESG. So such conditions make it difficult for the private sector to move towards the long term and to support greater sustainability and resilience coming out of the pandemic. Now, the 2020 Business and Finance Outlook focuses on these challenges and calls on governments and market participants to improve the ESG investing framework. In particular, it highlights several areas where policymakers can act. They can encourage greater relevance and clarity in reporting frameworks for ESG disclosures. They can come together to form a common set of principles and guidelines for consistent, comparable, verifiable ESG data. They can work towards a global framework because capital markets are increasingly globalized and must engage the financial industry in these efforts. To that end, I'm very pleased to have banks, rating agencies, and investors represented in our agenda today. And they can and should build on existing international instruments as the foundation of future reform, including OECD standards on areas like corporate governance and responsible business conduct. So, dear friends, our financial systems must deliver better environmental, social, and governance outcomes. And this will only be possible if investors have the tools, the data to assess the risks and to direct their investments accordingly. So this year's Business and Finance Outlook calls on governments and market participants to make ESG practices fairer, more transparent, more efficient. So we look forward to working with you all to answer this call. Thank you.
Thank you, Secretary-General. This report is indeed a call to action, and the OECD is ready to answer that call. We are, of course, a member-driven organisation, and we'll now hear the government, member government perspective from on this issue. Actually, we're home to one of the world's major banking markets. I'd like to now give the virtual stage to Deputy State Secretary and Head of the Department of Planning and Strategy in Switzerland's State Secretariat for International Finance, Stefan Flukiger. Welcome, Stefan, and thank you for joining us today. Over to you.
Thank you, Greg, and thank you, Secretary-General. It's wonderful to work with you again, this time on this issue of global importance. Dear ministers, ambassadors, ladies and gentlemen, dear friends, good afternoon. Welcome to this year's somewhat special launch of the OECD Business and Finance Outlook, with its focus on sustainable and resilient finance. It's obviously special because of the peculiar circumstances that we're all in due to the pandemic, but it's special also because of its timeliness. The volume of sustainable investments that integrate environmental, social, or governance criteria, ESG criteria, has soared exponentially over the past years. It surpassed $30 trillion US. That's about 1.5 times the US GDP. Increasingly, companies and governments issue green bonds, impact bonds, and other ESG instruments. Market participants joined the trend for various reasons. Some investors are primarily worried about the future of the planet, and rightly so, and they want their investments to have a measurable impact. Others worry primarily about their profits and want to minimize ESG risks in their portfolio. Among them, long-term asset managers with fiduciary duties and long-time horizons. So, what first has been a trickle, then a number of small creeks, has now reached a critical mass and is coming together into a mighty river. ESG is becoming mainstream. At the same time, and this is indeed special and goes right to the heart of this year's report, we, lenders, borrowers, regulators, and governments, have all very different ideas and no common standard of ESG, as the Secretary-General has just pointed out. We are all sufficiently confused about the measuring stick, the metrics, and the standards we should apply. So there is plenty of commotion, a good measure of confusion, but little convergence. What is missing is a clear-minded, well-structured analysis for all market participants, allowing an informed discussion about a common framework. What is missing is accessible, comparable, decision-ready data on risks and impacts. What is missing is data from real economy companies that allow financial institutions and their clients to incorporate sustainability into their decision-making. And this is where today's report comes in. It is perhaps the most comprehensive compendium of what is out there, both in academia and in the marketplace, and it lays out a very rich basis for our debate today. Increased transparency, once available, can spark technological innovation that can in turn play a major role in addressing sustainability-related challenges. Think of the potential global impact fintechs could have in the field of sustainability. Once we move towards integrational alignment on data, we can really operationalize our collaborative effort. In addition, having international alignment reduces the due diligence costs for global investors and the administrative costs of multinational companies. But it is not just multinational companies which we should be concerned about. Remember that the backbone of many of our economies is made up of SMEs, small and medium-sized enterprises. We want them on board too, and we must make it easier for them. We can all contribute to this common goal. Let me give you just a few examples why this topic is so important to Switzerland and how we are going to address it from here. Swiss banks manage more than a quarter of the world's cross-border wealth. This spring, the Swiss government, our central bank, our regulator, and all branches of the financial industry came together. And we stated our ambition that the Swiss Financial Center should become a leading global location for sustainable finance. This is not a light-hearted statement. Sustainability is already deeply rooted in our financial market. Last year, sustainably managed assets in Switzerland surpassed for the first time $1 trillion, increasing by over 60% year on year. In 2017, the Paris Agreement Capital Transition Assessment Initiative handed us an extremely useful instrument. It allows us to measure the alignment of portfolios with the Paris Agreement's goal, keeping global temperature rise below 2 degrees Celsius. This year, over 150 institutions participated in this voluntary initiative, covering more than 80% of the Swiss market. It is overwhelming. By the way, not all of them did very well, and this will be probably one of the outcomes also of the report. It will not make everybody happy, but at least we have a common standard. However, key levers to drive sustainability are not restricted to asset owners or asset managers. Corporate lending represents a significant source of global capital. Given its scale and significance, strengthening ESG integration in corporate lending practice is a must. This is why Switzerland contributed to the OECD Due Diligence Guidance for Responsible Corporate Lending and Securities Underwriting, published in Paris late last year. We urge everybody to support these guidelines. Now, so much about transparency and alignment in measuring of ESG data. However, it is important to remember that this is not the magic cure. We need to talk about carbon pricing. Financial markets will adapt to changing incentives in real economic conditions. If we succeed together through climate policy instruments, such as carbon levies, to render high carbon emission activities less profitable, markets will react accordingly. We must put a higher price on environmental damage, so that companies see it reflected in their profitability and in their asset price. Lawrence Boone, the OECD's chief economist, recently demonstrated that globally, the gap between current carbon price and required carbon price ranges from 27% to 100%. 100% are those who are not integrating transmissions at all. Switzerland today has already one of the world's highest carbon levies. On top of that, our parliament decided this summer to almost double the carbon levy for some fuels to $220 per ton CO2. The challenge is well known. We need to close the current price gap jointly, gently enough for industries to be able to adapt, especially in developing and emerging countries, smartly and firmly enough to prevent hidden protectionism, but fast enough to support global sustainability goals effectively and prevent systemic risks. So to conclude, if ESG investment were indeed a mighty river, then our task is quite formidable. We need to move the hills and valleys to nudge it into a new riverbed. The river should continue to run freely on its most efficient path, but within the path towards the SDGs, avoiding devastating gorges caused by market inefficiencies. We will achieve this with a common set of rules and standards on ESG data and with a global drive toward an adequate carbon price. It is vital that this is done by a forum like the OECD that has credibility and convening power on a global scale, both for government policymakers and private sector decision makers and opinion leaders such as yourselves. With this, let me hand over to you, Greg. I will be back at the end with a few concluding remarks.
Thank you, Deputy Secretary of State. Also, Secretary-General, ladies and gentlemen, that was a fitting introduction. And now I've actually got pleasure to present the key findings of this year's OECD Business and Finance Outlook on Sustainable Finance. The report is, and I think we should have that come up on the screen momentarily, if we can. But the report is actually rich really in analysis and discussion and guidance, and it would have been impossible to cover completely in the time we have. So I'll just focus on three main themes. First is the drivers behind the incorporation of sustainability considerations into equity and debt markets. And I'll focus here primarily on the incorporation of environmental, social, and governance considerations. Secondly, is how the current tools and practices do, or most importantly, don't support investors and lenders to do this. And thirdly, is to obviously look at the priorities to support better outcomes going forward. If we go to the next slide, what we can see is the market has, to what was just said, they've coalesced around ESG analysis as a primary means to incorporate sustainability and resilience considerations into investment and financing. That is the measurement and the rating of companies, portfolios and assets against specific material non-financial risks. And I just want to start by giving a sense of the scale of the market. We've heard the 30 trillion of funds under management, but just looking at the share of public companies with some kind of ESG rating worldwide, even though the number of ratings is low at around 10%, it's growing steadily. And as we see here on the left of this chart, particularly in the United States, it's actually growing quite fast. But more importantly, if we look at market capitalization of companies with ESG scores on the right side, 78% of total global market capitalization has an actual ESG score attached. So it's quite significant in terms of total market capitalization. 95% of those are in the United States, with market capitalization, 89% of market cap in EU, and 78% of market cap in Japan. So it is being used quite widely, very significant for big, large companies. And what's driving this growth? Well, the outlook details the growing appreciation across financial market participants that non-financial ESG risks and opportunities can and do have a material impact on long-term value. Let me just give you 4 examples that are on this chart. Firstly is investors are looking to use non-financial information like ESG factors to guide asset allocation decisions to improve long-term risk-adjusted returns. Secondly, fiduciaries like boards and asset managers are increasingly incorporating sustainability considerations into their decision-making, their strategy and their risk management to meet their their fiduciary duty to investors. Thirdly, on the debt side, banks, it was mentioned before, banks are seeking to enhance their due diligence in lending practices and strengthen the integrity of instruments like green bonds. And fourthly, businesses are also adapting to shifting expectations from the community, from the crowd, but also from many governments around business conduct and the need to play a more visibly positive role in societies. And orientating investment activities towards the long term is a key means of meeting that expectation that's emerging from stakeholders, and most importantly, avoiding reputational risks. So, and of course, COVID-19 pandemic has underlined where businesses and markets are vulnerable to future shocks, but most importantly, tail risks. That is low probability, high severity events. So I don't need to say anything more than that. To be clear, the incorporation of ESG risk factors for the vast majority of investors, it's not about social activism or the pursuit of specific values. And for fiduciaries, in most fiduciaries have a single objective. It wouldn't be appropriate to do this with other people's money unless investors specified otherwise. It's actually about consideration of material non-financial risks, which is a fundamental part of investment and asset selection. If we now look at the tools that investors and other financiers have to assess ESG risks, and the opportunities, we see a lot of progress, particularly from rating agencies, in providing ESG scores for companies. And we highlighted that in my earlier part of the presentation, and on which it's actually which investors and lenders and index providers rely. But what we've also found is significant shortcomings. In particular, while there is a wealth of ESG data out there, it is not consistent, comparable, or easily verifiable. And what we did is we mapped the correlation between ESG ratings for the same company across 3 different ratings providers, as shown in this chart. And if companies receive similar ESG ratings between providers, these data points would actually line up close to the middle of the line. You can see the dotted line going through there. But as you can see, there's wide variation around that line. And in fact, companies ranked by one provider get a much lower score than others. And the correlation is actually quite weak. It's actually only 0.4, which is quite low correlated. And this analysis is due to really a number of reasons, which is the wide range of methodologies, metrics, weightings, and the level of subjective judgment within ESG ratings. If we look, there's nothing wrong with different methodologies, but we would actually expect that ratings empirically measuring the same ESG risk factors in the same company to reach similar conclusions. as rating agencies do in credit scoring. And that's what's shown in this slide. As we can see on this slide on the left, we see a wide variation in ESG ratings from different providers for a sample of companies. And you can see there is a very wide range. On the right, just to bring home what I was saying, we've got credit ratings from different providers, but what you can see for the same companies, we can see that they're actually quite closely aligned. So if you've got such a wide variation of ESG scores, the link between materiality and ESG is also unclear. And though ESG indices have performed well relative to the mainstream ones since the start of the pandemic, we actually find little evidence to suggest that strong ESG ratings are linked to overperformance. And what this really does is suggest that ESG practices are not supporting enhanced consideration of material risks. And what it means, most importantly, it makes it hard for fiduciaries to explain and to justify decisions they make that are informed by ESG considerations. So it's a very significant factor at the moment. Our actual outlook illustrates these issues through a detailed analysis of the environmental, the E component of ratings, and specifically carbon emissions. And when we looked at the three major ESG rating providers, in two cases, the higher the environmental score awarded to a company, the higher the carbon emissions for that company, as we see on the left of this chart. And when we even adjusted for the revenue, which is to look at the size versus the carbon emissions, there's still a wide variation between providers. And one provider still had a notably high level of emissions in environmental scoring companies, as we see on the right-hand side of this chart. So clearly, we cannot rely on ESG approaches in their current form to, first of all, manage carbon exposures in portfolios, which is what many private investors actually do, is use rating scores. And secondly, obviously, in terms of thinking about greening the financial sector, which many public institutions are looking to do. So when it comes to ESG ratings and disclosure more broadly, investors, lenders, other financial decision makers cannot rely on the current data to accurately compare material ESG risks and opportunities between companies. And most importantly, as we talked about earlier, pricing those risks and then allocating funds accordingly. So we found this over and over again in different contexts. We saw it was difficult for boards, for institutional investors, in infrastructure financing, and obviously in banks. So on a side note, I just want to emphasize, we're not looking to single out rating agencies here. It's just that this is where the data lies, and it's a testament to how far they've come if we look at the rating coverage on ESG data and disclosure. So, where does this lead us? Well, what we need, as was said by the Secretary-General earlier, we need better incorporation of ESG factors to actually align with long-term value and therefore align with financial market activities. So the market can better price the risks according to, the goals and community expectations. But current ESG practices are falling short. And the challenges that I've described could eventually undermine confidence in their efficiency and squander this potential. And we believe that policymakers must step up to make ESG practices fit for purpose. The first is that the headline priority is working together towards a global, mandated, auditable ESG data framework, reporting data framework, to actually drive better transparency and standardization of the core elements of ESG disclosure. And this can be flexible and scalable and adaptable to national circumstances. But what we need is a set of minimum data points to track and compare ESG performance. As we always say, if you can't measure it, you can't manage it. And we know we've got voluntary industry standards, but they're not enough to address these issues. You need mandated standards. Secondly, we can strengthen the regulatory environment, including regulatory guidance on ESG data disclosure, appropriate labeling of ESG products to ensure their link to materiality is clear, and defining long-term financial materiality to better capture the slow-moving environmental and social risks. And part of this greater engagement is actually needed between the financial industry and the public sector. Thirdly, governments can themselves set a good example by incorporating better ESG practices and data disclosures into their own, what they do, such as if they're an owner of a government enterprise or they're dealing with infrastructure, for example. So they themselves have opportunity to lead by example. Then finally, there is the existing policy standards and guidance that the Secretary-General mentioned earlier that could already improve practices if fully implemented, which form a strong basis for reform going forward. These include the OECD instruments on corporate governance, on the governance of state-owned enterprises, responsible business conduct in supply chains, and guidance on due diligence for institutional investors and lenders that was mentioned by the Deputy Secretary earlier. And these priorities are exactly what the OECD will be pursuing in the time ahead. So now stay with us as we delve even deeper into these issues with our panel. And I'll now hand over to the panel's moderator, Anthony Curry, Associate Editor of Reuters Breaking Views. Over to you, Anthony.
Great, thank you, Greg. I'm just going to do a quick mic check. Can you hear me? You guys hear me? I'm going to assume, great. It looks like I'm getting a thumbs up. Sorry, I just had, of course, because we're having a big virtual event, I just had a minor internet outage, so I just wanted to double check. So thank you, Greg, and thanks to the OECD for asking me to moderate the panel today. Just quickly by way of background, as I'm sure a lot of you don't know who I am, from Adam. I'm one of the editors at Breaking Views, which is the financial commentary division of Reuters. We're perhaps best known for offering our take on big mergers and the goings-on at the major investment banks. But our general remit is to follow the money, or as I would argue the case is with climate risk, spot where the money is likely to go or should go to. And that's why we started delving into the financial and economic risks and opportunities of climate risk some 5 or more years ago. Now, back then it was an important, if relatively small part of our output, but in the past 18 months especially, interest among our readers, who are mostly senior bankers, investors and policymakers, has grown spectacularly. And just think about what's been happening recently. Last week in New York, which is where I'm based, is Climate Week, where companies from Microsoft to Walmart set new targets on everything from water use to carbon emissions to food waste. And the likes of the UNPRI and CDP now say they have support on environmental issues from investors managing more than $100 trillion in assets. So just imagine what we could achieve if all of those assets actually went into dealing with climate issues. Now, my basic approach, just so you know, is that ESG concerns, I don't like the term ESG, but let's use it, are absolutely central issues to be considered core issues when investing and lending, along with plenty of other factors. There really shouldn't be anything new about or anything special about ESG to my mind. Basically, it's all part of investing. But of course, we need to make sure that those risks and opportunities get higher up the scale, which is why we're focusing on it as a separate idea, as much as many of you are. But these have to be done right. And I think today's OECD report marks an important step along the way to getting there. Now, our panel is going to dig into some of the findings of the report, as well as how sustainable finance fares after COVID-19. One bit of housekeeping before we start, and it's from my perspective. It's 7:30 in the morning here. I have 2 young kids. My office is the kitchen. The chances of them coming in and disturbing me at some point are relatively high. So I'd apologize in advance, but it's basically the new normal. But I just thought I'd let you know in advance. Now, with that, I'd like to start us off by handing the mic to Sergio Amotti, the Chief Executive of UBS, who's going to kick us off. Over to you, Sergio.
Thank you, Anthony. Ladies and gentlemen, good afternoon. I'd like to thank, first of all, the OECD and the Secretary-General Gurria for the opportunity to contribute to the important discussion on how sustainable and resilient finance contributes to the recovery from the pandemic. So the experience of the COVID-19 pandemic has demonstrated the devastating impact when we as a society are not prepared to tackle risk, which, by the way, were well known. Similarly, climate change and other sustainability issues can have catastrophic consequences if they go unmanaged. So economic recovery from the pandemic, which is being supported by substantial public funds, is an opportunity to promote and set the right incentives for building the sustainable infrastructure of the future. Financial markets will play an important role in this, and at UBS we are convinced an orderly transition to a low-carbon economy is vital for our business and the economic prosperity of our economies. Against this background, our climate strategy supports our clients and our firm in preparing for success in an increasingly carbon-constrained world. On the lending side, for example, we have reduced financing of companies that have a negative climate impact. The carbon-related assets on our balance sheet were reduced to 1.9 billion, accounting for 0.8% of total assets at the end of 2019, down more 40% from the previous year. And we have further tightened financing standards related to fossil fuels. The guidance provided by the OECD to investors and lenders on how to enhance their due diligence of sustainability risk is helpful. However, we are not doing this overnight, but rather in a fair, transparent, and one may say sustainable way by supporting companies in their transformation. Because to me, responsible action also means that we have to contribute our part towards a well-functioning economy that generates jobs and tax revenues. We can help companies move out of certain areas, but we must also make sure that these companies then continue to exist. If they collapse, no one gains. Precisely for this reason, we cannot look at environmental aspects in isolation. Social and governance aspects are just as important. This triangle must be correctly aligned. Managing exposures from a risk perspective is important to protect clients and banks' assets. However, and this is very important to me, we are not just dealing with sustainability from a risk perspective. At UBS, sustainable finance has been a critical component of our client offering and a strategic growth opportunity for many years. Our goal is to strengthen our leading position in sustainable finance by expanding and delivering a pipeline of innovative, commercially attractive solutions for clients. Recently, UBS became the first major global financial institution to make sustainable investments the preferred solution for our 2.6 trillion global wealth management business for clients investing globally. This builds on prior work of integrating ESG consideration into the investment process for all the active equity and fixed income offerings in our institutional asset management business. But it's not only the growing volume that's telling me sustainable and impact investing are evolving from niche to mainstream. The fact is that all this is happening without sacrificing competitive financial returns. By taking responsibility to reallocate private funds to achieving sustainability goals, we are actually helping our clients participate in growth opportunities, in particular in the aftermath of this crisis. Ladies and gentlemen, we all want to make the world a better place for our children, our family and friends, and others that we care about. And the financial sector is a key facilitating sector. However, we must recognize the limitations. That's why the United Nations Sustainable Development Goals are needed. Cross-collaboration will be essential. Partnership in many forms, public-private partnerships, partnerships between different industry players, and so on. First and foremost, we need effective public policy addressing the primary sectors. For example, a true and ideally globally applied price on carbon would be the most efficient measure to incentivize investment in low carbon technologies. I'm convinced this would also be much more effective than some of the non-market-based regulations that are being proposed to bring about change. While such a carbon price would be a significant challenge for some industries, it would also send a clear signal and force corporates to work on their transition, which can be then again be supported by banks and investors. Of course, we cannot disregard the political implication, and this is certainly not an easy thing to achieve. In the absence of a global carbon price, other measures will and should be pursued. We also need sustainability regulations for the financial sectors to be aligned with the requirements in the so-called real economy. For example, disclosure requirements such as those recommended by the TCFD and SASB for non-financial corporates are an important prerequisite for many financial sector regulations in the sustainability space to ensure data availability. To sum up, we are doing our part, but need consistent and coherent policy frameworks. This is a joint effort. You cannot legislate change, and you certainly cannot do so via financial markets alone. We can only succeed if all relevant stakeholders work together in partnership. A strong and sustainable recovery from the pandemic needs a healthy and competitive financial sectors, and vice versa. Thank you.
Great, thank you, Sergio. Now, I'd just like quickly to introduce the panel. You can all see, I'm sure, the names in front of you. But just so you know, we've got one change. Marcel Haag from the European Commission couldn't make it, so Alain Dekkers has very kindly offered to step in from the European Commission on his behalf. We've also got from the Nederlandse Bank, Ruben, former Finance Minister of Chile, Felipe Larraín, Linda Elling-Lee, who is head of ESG research, MSCI, from the Financial Services Agency in Japan. Nice and late there at 8:30 in the evening is Tokyo Marita. Thanks for joining us late. And a special thanks for joining in at shouldn't be up at all o'clock in the morning in California, Anne Sheehan, who was formerly Director of Corporate Governance at CalSTRS and recently sat on, or chaired even, the US SEC Investor Advisory Committee. So we've got a fair number of things we could jump off into, but I'd like to start with you, before we dive into some of the nitty-gritty of the BFO report and what happens next. Let's just step back and try and working out how to combat climate change had become an ever larger focus in the years following the Paris Accords in 2015. Then COVID-19 hits. Where does this leave us? Has the pandemic shifted focus from climate change? Is it useful lessons for us? I'd say that it basically stopped everything for 6 to 8 weeks, but it's largely come back. But is that something that you've seen as well from your perspective? You're far better plugged in than I am, I would say.
Thank you, Anthony. I hope the microphone is working okay. It's a pleasure to be here. I think it's an extremely topical and timely report the OECD has produced. Let me just make 4 sort of overarching big picture comments. The first is that indeed in 2015, barring one jurisdiction, but governments and heads of state committed to the Paris Accord. So the democratic commitment is there, but we needed something to get all businesses to align their behavior with this accord. And clearly the financial sector has a central role in allocating resources. So we need instruments to get there, and the ESG reporting is part of this. Well, so this had a lot of, the Paris Accord had a lot of attention, and then attention sort of seemed to sip away to the Corona crisis. I think the COVID crisis teaches us 2 things. First, that nature is not going to bend to what humans want. If you think of the tens of millions of people working on vaccines at the moment, and if you see how difficult it is to get this crisis into manageable proportions, that foreshadows the sort of challenge that is before us with climate change. The second thing that we are learning in these times of crisis is that human behavior does adapt. When we really need to adapt, it's surprising what is possible. And it's surprising how far humans will go to actually make their behavior more in line with what nature is telling us we need to do. And in fact, in the Netherlands, starting today, we've tightened again our working home policies. So that just illustrates the fact that humans can adapt. The last overarching comment I would make is that in 2020, carbon dioxide emissions are 8% down in the year relative to the year before us, relative to 2019. That's the strongest decline in carbon dioxide emissions that has ever been recorded. It's 6 times the size of the decline after the great financial crisis. Now, the interesting thing, though, is to put this into perspective, because this decline of 8% is what we need to achieve every year until 2030 if we are to realize the ambition, at least in the European Union, that we have set to reduce CO2 emissions by 55% by 2030. So clearly, we have to step up our act, and ESG has to play a central role in that. And now perhaps it's time to get into the nitty-gritty on ESG, and I'll give you the floor back, Anthony.
Great, thanks, Ed. Sorry, to make sure that my kids don't make too much noise, I keep muting myself, so apologise for the occasional delay. All right, let's bring in some other representatives from the world of policy making then. So, Tokyo Marita, how does what Japan is trying to do compare with, say, the EU's approach? Actually, we'll get to the EU's approach in a minute, but we all know they've got the big taxonomy on climate in the works. So, and we'll get to that in a second. But Tokyo, having heard what Ed says, I mean, what's Japan up to at the moment? I mean, how would you frame the debate from your perspective?
Thank you very much, Anthony. And thank you very much for inviting me to this seminar. I'm very much honored. First of all, I think this year's BF report is a very good report, a little bit provocating, but I've learned a lot, and thank you very much. Now, I think that the importance of ESG, and particularly climate change, is now well shared. And the concepts such as physical risk and transitional risk and so on and so forth are well being established. But as it is pointed out by the opening remarks, there is a lack of data, and this is a serious problem. So at this stage, we believe that it is not ruled out that the authorities may make mistakes. So we are not taking a binary approach, green or not green, or we are not taking the regulatory approach, but we are taking more voluntary market-based approach. We are focusing on the awareness raising and urging the firms to join the movement and voluntarily disclose more non-financial data so that we can enrich the database and the facts available in the market. So specifically, what we are doing is firstly reporting, urge companies to make the ESG disclosure under the TCFD format framework. I understand that globally 1,419 companies are participating in the exercise under the TCFD framework, and out of which 303 are the Japanese companies, and this is the largest number by country. And secondly, to the sort of regulated financial firms, we have a dialogue on the risk management. We are budgeting with questions how they manage the ESG related risk. And thirdly, on the engagement front, we devised the corporate governance code and the stewardship code. And now in the corporate governance code, it is made clear that the listed companies should respond appropriately to the ESG challenges. And in the stewardship code, it's a code of good conduct for the institutional investors, but institutional investors should consider the ESG factors in making the investment decisions. That's what we are doing now. Thank you.
Thanks, Tokyo. Now, let me bring you in, Alain. I actually meant to bring you in before Tokyo, so apologies for that. But obviously, the EU, as I said, has its taxonomy under development, and we've seen a lot written about it, a lot's come out. But let's just, it's a taxonomy for sustainable development. European Commission President Ursula von der Leyen earlier this month, I think, was one of those who promotes cutting emissions more aggressively. Of course, we then had the Chinese president last week say similar issues at the UN. Now the continent's getting whacked by a second wave of the virus. How do the European Commission try to flesh out what to do next? I think you're still muted, Anna.
Can you hear me now?
Yes.
Yes.
Excellent. Thank you very much. Well, first of all, thank you for the invitation, and I do apologize on behalf of Marcel, who wasn't able to join us due to a last-minute commitment. So I will try and fill his shoes, which is not easy. Let me try and reply to your question in three parts. First of all, what have we already done? Secondly, what do we have in store with the new sustainable finance strategy that we're developing? And then how does sustainable finance fit into the green recovery more generally? So I'll start with what have we already done. Everybody knows we published a Sustainable Finance Action Plan in 2018. And following that, we have already put in place a number of pieces of the puzzle. That includes, as you've mentioned, the taxonomy regulation, even if for the time being it's only the framework regulation that is adopted. We're currently working, hopefully by the end of this year, on some regulations on the climate taxonomy, and then following that, there will be a second round of work on the broader environmental objectives. We've also put in place legislation to establish low carbon benchmarks, so-called EU climate benchmarks. We've adopted the regulation on disclosures for financial market participants, asset managers, and so on. So quite a lot of work has already been done. My team in particular at the moment is working very intensively on a review of the non-financial reporting directive, which addresses some of the problems that you've highlighted that previous speakers have highlighted, and that your report highlights about the lack of comparability of information, which is one of the fundamental problems that lies at the base of this whole pyramid of ESG work. And that will hopefully strengthen that basis. And we're also continuing to work on development of the EU Green Bond Standard. We've currently got a consultation running until the early October of this year. So quite a lot of work has already been done, but clearly we're not there yet. So we have consulted earlier this year about a follow-up sustainable finance strategy that we hope to present by the end of this year. This will probably have to be quite a wide-ranging strategy, quite ambitious also in light of the new objectives which you've just referred to in terms of reducing climate impacts and emissions by 2030 and also by 2050. And it's quite clear to us that there's no sort of magic bullet, so there's no single measure that will solve this problem. We are going to have to look at a range of measures. And some of those that have been mentioned today, such as, for example, the concerns about the lack of comparability of ESG ratings and so on, may be part of that story. Then more widely on the role of sustainable finance in the green recovery, it's clear that with the pandemic does not mean that the climate challenge or the environmental challenge more widely has gone away, notwithstanding that marked reduction that's expected in emissions this year. which is, of course, welcome in itself, but perhaps is occurring for the wrong reasons. Notwithstanding the pandemic, we need to step up our efforts, and indeed, the pandemic shows emphasizes the fact that dependence on the natural world is an increasingly important element in our world. So, as you have mentioned, President von der Leyen has announced a number of quite ambitious targets, both in terms of reducing emissions, but also in terms of allocating funding from the EU's budget to green environmental objectives. 37% should be allocated to new green objectives, and also 30% of the money should be raised via green bonds. So quite ambitious objectives across the board. What is clear to us is that while public funds will have to play a role, we have already for some time concluded, and I think this is a widely shared conclusion, that the private sector must play an essential role, and therefore our sustainable finance policy has been aimed largely at mobilizing private funding and at ensuring that financial markets increasingly divert or allocate funding to green objectives and to sustain a transition to a sustainable economy. So we are undertaking a number of steps there. Our focus is on working with financial markets to mainstream sustainability in decisions on fundings and investments, to help markets to achieve an orderly transition away from harmful activities from a climate and environmental point of view, and empowering and providing transparency to investors to ensure that they can be confident that investments are being allocated to green economic activities and financial products, and that this is not just greenwashing, which is, of course, a key element of a key objective of the regulation that I mentioned earlier on disclosures by financial market participants, but will also be very strongly supported, and is also one of the objectives of the review of the non-financial reporting directive that we're currently putting into place. Obviously, the taxonomy has an important role to play in all of this also, and we must ensure that increasingly in Europe, economic activities are allocated, or investments are allocated to economic activities that are consistent with the taxonomy, hence the importance of that work that I've just mentioned on the development of the taxonomy, both for climate and in a second step for other environmental objectives. So I'll stop there in order to allow others enough time. Happy to take any questions if there are. Thank you.
Thanks very much for that. And again, thanks for stepping in pretty much the last minute to help us out here. Felipe, let's bring you in here now. We've heard green bonds mentioned several times now, and also, of course, what I will say is intriguing is the idea that carbon emissions have fallen a bit this year, and yes, we need them to fall every year. I just want to say as an aside, my general feeling about this, the best thing about this, and the only good thing about it, because I don't think we should overstate it, is it does give us that a few extra months' time. I was thinking at the beginning of the year, or the beginning of the pandemic, look, at least with COP26 and other big events being postponed, at least the reduction in carbon emissions gives them a bit more time to get moving. And I'm glad to see with Climate Week last week and with what the European Union is up to and others as well, that actually that seems to have been taken to heart. Now, so Felipe, over to you. When you were Minister of Finance in Chile, you helped organise and issue the region's first green bond. We mentioned green bonds mentioned a few times today already. Just from your perspective, what can we learn from what you did with that green bond, and how that can then how we can then look at what we do, and how we're looking at Europe issuing 30% of the money through green bonds to help pull us out of this. What lessons can you bring us to the table from what Chile did?
Well, thank you very much, Anthony. It's a pleasure to be here at this panel. And I think that this report, the Business and Finance report of the OECD, is extremely timely. It's extremely valuable for what we do in, in the realm of public policy. Let me just say a few issues about the green bonds and the lessons that we learned. And I think these are lessons well beyond what we did in Chile. The first thing is that it's mentioned in the report, but so far there are 16 governments which have issued over $80 billion of green bonds, and there are 5 additional governments considering an emission very soon. For us in Chile, in 2019, issuing a green bond fit perfectly into Chile's climate action objectives, where I would highlight Chile, the fact that Chile led the coalition, the first coalition of finance ministers, with about 50 countries inside that coalition back in 2019. Chile co-led with Finland, that coalition. The second issue that I would highlight is Chile's commitment to carbon neutrality by 2050. This Paris, commitment, and we are on our road to comply with it. And the third is a public-private green finance partnership. We have established basically a working group where we tackle these green financial issues. What did we do with the first issuance of 2019? Well, we raised over $2 billion in dual currencies, in euros and dollars, and demand exceeded the quantity offered by about 13 times in dollars and 5 times in euros. Well, what did we get? I would say as lessons of this process. First is that there is need to work here. I mean, governments need to work to produce the issuance of a green bond. There are several months of work, and some countries are deterred by lack of understanding of the process or by over projecting the amount of work. So I think there is a work to be done here. Second issue is the need to have clear identification of projects, and here, you need to have projects that qualify for a green bond emission. And here the rating process and many of the issues that are raised by this report are very useful. The third issue, of course, we need to have a certification of the bond as green. And you have involved a rating agency. Using this opportunity, we created an institutional base in the public sector. We established responsibilities of different government agencies in the measurement, report, and verification of projects. We determined which are the eligible types of government spending and the sectors that can be financed. We developed a comprehensive framework making fully transparent the process of project selection and resource allocation. And on top of this is not only, and governments, need to understand, it is an issue of environmental responsibility, but also it is an issue where we call the green premium. We obtained 5 basis points on the yield lower than the regular sovereign bonds of similar maturities. So that is a very important part, and governments need to understand that beyond complying with environmental objectives and responsibility, there is a financial reward. The other thing I would highlight too is that diversify the investor base. The majority of investors that came in with the green bonds have previously not purchased Chilean securities, Chilean sovereign securities. So I think this was, in a sense, it was a very novel thing because it was the first green bond issued in not only Latin America, but in the Americas. And we attracted a lot of other, of investors, which are have in their rules investing in this type of assets. So we captured this audience, this demand for this type of securities. The other thing that I would mention also is benchmarking, the benchmark for the private sector in different currencies and maturities. By issuing a sovereign green bond, we're issuing a benchmark for the private sector. And let me let me end with just one reflection that green bonds, if appropriately understood and with the help of things like these OECD reports, can become a way to mobilize resources for COVID-19 recovery. Governments are now trying to mobilize resources, and of course, we want this to be a green recovery. A green bond is a perfect fit for this kind of major challenge that we're facing today. Thank you.
Felipe, great. Thanks so much for talking us through that. I mean, there's a lot in there that is useful and a lot in there that is encouraging. And although I take your point that it can seem daunting at the beginning of the process for an issuer. So, Anne-Jean, let's turn to you. And if you can't spot it, there is a wry and quite possibly annoyed grimace on my face as I sit here in the US listening to various people, policymakers, regulators from around the rest of the world talking about how much work they're doing, how important it is to make sure that sustainability, climate risk, ESG, whatever you want to call it, is top of the agenda. And I think what Felipe just said about how issuing a green bond can set a benchmark for the private sector to go out and do the same thing is important. And yet here, you and I think Linda Ellingsley as well, we're all in the States where the federal government, at least, is taking a very different approach. And obviously, Anne, having sat on the and chaired one of the SEC boards on this, you know this far better than most. But I mean, let's just try and keep the exasperation out of voice. I'm allowed to. I'm an opinion writer. I can do whatever I want. But I know you guys can't get too caught up in the politics. But how do investors in the US deal with the fact that in the rest of the world, governments seem to be, certainly in Europe, Japan, much of parts of Latin America, governments seem to be wanting to play a big role in this. In this country, not so much. How does that play into how easy and difficult various issues can be? And you and I spoke last week, and I've written about the Department of Labor proposed rule on so-called ESG investing, a term I'm not a fan of, as I said. But over to you. What do investors do in the US with all this going on behind them?
Thanks, Anthony, for the question, and thanks for the opportunity to participate in the panel. I, too, compliment the OECD on the report. I think they laid out the proposition well, so much good data in there, and it captures the state of what's going on. So with regard to the U.S. and the investors here, and I know Linda will touch on this, I guess my advice to the investors and what they're doing is sort of keep calm and carry on. The investors have very much taken this issue into their own hands. And through their engagement activities, their investment activities, are really addressing the ESG issues kind of at the one-on-one at the grassroots level with companies in their portfolio. Not just the asset owners like my old group, CalSTRS, and other large asset owners and pension funds in this country, but also the asset managers. You look at what BlackRock has done, what State Street, and even Vanguard, some of the large established asset managers in this country are engaging on these issues. Now, some would say they may not be going far enough, but they are beginning to have these engagements and discussions. Shareholders are, through what we call in our markets, private ordering, and they are asking companies through engagement or shareholder proposals to disclose some of these ESG risks. It's been an issue on the agenda for places like mine, asset owners, like I was at CalSTRS for many years, integrating ESG into the investments. As Linda knows, we worked with her group to develop an index for CalSTRS, a low carbon index. So it is going on, but I think the investors have to really continue at the grassroots level to push for this. Anthony, as you mentioned, the regulators are not moving forward on this. And in fact, some would argue that they're actually moving backwards with the Department of Labor initiatives. But I think the investors are responding that they do need this information because this non-financial material information affects how they deploy their capital and impacts the returns of their portfolios. So they have an obligation as fiduciaries to look at these issues, even if the regulatory mechanisms in our country are not recognizing the reality of this. Sometimes I used to say that the SEC can be the lagging indicator of what really the markets are looking for in our country. And I think this ESG debate is a sort of indicative of that approach. Now, I don't want to say that the SEC is not doing anything. There are a few green shoots in this regard. And as we talked about the COVID crisis, they did come out with some guidance on human capital management disclosures and what they're looking for companies. So I think they're recognized even under their principles-based approach, which is really how our SEC takes their approach to materiality disclosure by companies. But they did look at this issue during the COVID crisis, issuing guidance in March and April, providing for more information to investors around employment issues, how they're treating their employees, what the benefits are. So I think there's a recognition that these issues are important to investors. As you mentioned, I used to chair the SEC Investor Advisory Committee. We did make a recommendation that they pull together a roundtable on better ESG disclosure, looking at the frustration that investors have with, as has already been mentioned here, too many disclosure frameworks. Companies are being inundated by surveys. Investors have all of these various disclosure types of frameworks that they can use, and there is an effort to coalesce around these. I was heartened by the announcement a couple of weeks ago by GRI and CDP and SASB and others to try and come together to develop a more common framework for these disclosure frameworks. So I think there are things happening here in the US that will help move this dialogue along. I don't think we're going to depend on our regulatory agencies to do this. It really is up to the market participants, as has been mentioned before, in these markets to do this. We've seen the flow into ESG funds, as has been mentioned, in terms of the 30 trillion in US dollars that has gone into ESG funds. Another green shoot that I see in this country is the Asset Management Committee of the SEC is looking at ESG funds and may make a recommendation over the next few months about what the SEC should do on more disclosure as to how these funds are defined. So I think we are seeing a bit of hope, but for the time being, I would say that the investors, as I mentioned, sort of have to keep calm and carry on with the work that they're doing at the grassroots level. So I would turn it back to you, Anthony.
Great. Thank you, Anne. You're far more diplomatic than I am. Well done. Linda Ellinglee, let's come to you now. As I sort of mentioned to you in preparation, and I think as Greg pointed out in his opening remarks, often it seems like we're picking on the rating agencies, which is nothing new. I mean, if you go back to the financial crisis of 2008, the crisis of 2001, and before that, credit rating agencies were often the ones that we'd look to and say, oh, look, they're the ones who got it wrong. Let's blame them for everything. I think as Greg pointed out, and as the OECD report points out, agencies like MSCI on ESG risks are the ones who actually are collecting most of the data. So you're almost sort of getting drawn into the middle of the debate here because you're one of the few ones who are actually getting the data here. But let's face it, you are the ones that as a result are going to be seen as causing or maybe projecting some of the issues here. I think as the OECD report goes into, there are concerns about lack of correlation, consistency, whatever. And I think that's in general about data, not just necessarily about some of the outcomes from some of the ESG raters. But how do you deal with that? How worried are you, whether it's you, MSCI, whether it's Refinitiv, which of course my company still owns a minority stake in, or others? How worried are you about that this is becoming a risk for you as a business, that the raters will be identified as the ones with the problem?
Well, first of all, I'd like to thank the OECD for taking on this topic. I do think it's very important for an institution such as the OECD to take a much more systematic look, because I think there are actually quite a lot of superficial pieces out there that compare apples to oranges without really engaging with what it is we have today and why we have what we have and what it is we don't have at this particular juncture in the development of the ESG investing field. So ESG scores exist because the data by themselves is actually really hard to interpret. It's really hard to compare. It's really difficult to use. And that's not actually just because corporate disclosure in this area is much less developed than accounting and financial disclosure, something that's been discussed a lot in different forums. It's also because ESG data actually just covers a vast landscape of topics, right? So some of the data are macro and context dependent, like if you're looking at the exposure of a company's different business activities to areas of water stress. And then some of it is really company specific, like which individual directors bring different kinds of capabilities to a board, right? So it's very disparate type of data and information. And so scoring and rating is something that's necessary, whether it's by a third party or internally, to bring some order and some consistency to that information. Now, ESG ratings, as you said, have been compared to credit ratings and favorably, as Greg also showed at the outset there. But it's really important to point out that credit ratings are all trying to capture the same thing, right, which is the probability of default. And this might not actually be the case for everything that's labeled an ESG score or an ESG rating today. We're not necessarily potentially trying to capture the same things. And that is actually a very important distinction that I think this BFO report actually points out throughout its 200 pages, which is quite hefty, which is this need to distinguish between whether strategies or metrics are trying to capture value-based factors or financially driven factors. So some ESG scores really are simply trying to aggregate all the ESG information available about a company so that investors have something simpler and more aggregated to work with. And then other ESG scores and ratings actually have an underlying model that is just trying to capture something that's actually more specific than this, maybe kitchen sink full of ESG stuff. So I think that one of the things that I wanted to kind of give a shout out to or to highlight in this hefty report is actually the original quantitative analysis that was done. Because beyond making the point that different ESG scores and ratings have different underlying ingredients and proportions of those ingredients, I think what's quite interesting is the analysis compares different ESG ratings to financial performance, right? And it's showing inconsistent relationship. But part of that inconsistency means that some ESG ratings have been more effective, right, at capturing financial risk and performance. And I do think that one of the most actionable recommendations from this report is that investors should actually analyze the underlying drivers of why and when ESG ratings, relate to risk and performance. So we've done quite a lot of this kind of research at MSCI to dissect our own ratings model, because we need to learn from that to improve the ratings model, but also the market actually really should learn which ESG issues have mattered more and mattered less from a financial materiality point of view. And so, for example, some of the recent analysis that we've done looks at 13 years of data. That's the longest consistent data history in this industry. The market has been, for example, pricing governance-related issues that are captured in our ratings model much more quickly. So over a 1-year forward time period. And some of the environmental and the social issues in the ratings model actually have tended to take multiple years to actually show up in stock price performance, right? And we've also analyzed how much the weighting scheme between E, S, and G issues in the ratings model contribute to capturing risk and performance. And you can test alternative weighting distributions and how kind of that shifts the relationship. So I do really think that when we talk about the drive towards greater transparency and standardization of what's considered financially material, it really has to be based on quantitative evidence. Right? And so I really think that one of the components, as the policymakers in this audience think about how to improve transparency and standardization in this area, it has to think about how ESG ratings and scores should be providing this kind of underlying analysis so that the selection, the weighting of the ESG factors have to be more sort of evidence driven. Now, to the criticism and whether or not I fear, I get asked quite a lot about, whether or not I worry about investors all just kind of blindly following ratings and what that does to the markets and so forth. So that's really just not my experience. We work with over 1,400 financial investment institutions that are using our ESG inputs, and I can tell you no one's blindly following anything. And to that point, first of all, we recalibrate our ratings model every year. So we add and drop ESG issues that are included in rating each of the 156 industries based on changes in emerging risks. And every single one of these clients are actually consulted on these proposed recalibrations every year. And major investment institutions provide quite a lot of time and feedback on where they would like to see more weight or less on industry-specific issues. So there's, I think, a fair bit of transparency as well as feedback. And so the model does, I think, reflect some level of market consensus. I think this is, I would like to say that is a best practice, and I do think that other scoring models out there should undertake this kind of much more transparent kicking of the tires by the market and by industry players. And then in terms of using the ratings, what we see is that investors want strong building blocks, right, to construct ESG strategies. And an important building block might be third-party ratings or scores or ones that they have developed. But they have different approaches. They have really different investment objectives. And so I think, one of the chapters in this report does actually set that out extremely well. Investors are actually putting together building blocks of data, and some do include ESG ratings and some do not. So I think that this public perception that somehow all the money is following, these are not buy and sell recommendations. These are not decisions that people are making just in or out when the ratings change and so forth. I mean, I think that is just a misconception in the market.
Right. I mean, if I push back on that a little bit, though, I mean, I think end of the day, it's going to be investors like me, right, who are going to look at this and say, there's an ESG fund I can invest in. And yes, what you're saying is absolutely right. And I agree with you. I think that it's always easy to blame a particular provider, especially when a crisis hits. When I remember back in the financial crisis, all these allegedly very clever and smart mortgage investors suddenly started blaming their investment banks or their rating agencies for what they had got wrong. So I can see that happening anyway, regardless of everything you say, just because that's the nature of the beast in many respects. But I'll give you an example, a very small example from a personal perspective, which I think I mentioned to you before we came on the call. So a year or so ago, my wife and I had a very, very interesting New Year's Eve where we finally decided to set up some college funds in the US for our kids. And we thought, let's search for an ESG fund. And we found one in a $300 billion industry. I'm sure it's improved since then. And you click on it and you see the top 10 companies in there, and it's Microsoft, it's Apple, it's like, what is this? Why are these even in there? I can buy these funds, these names myself. Why is this actually an ESG fund? It's just a bunch of companies who may or may not have done a good job. I get no indication as an individual investor of why I'm actually buying something that is meant to be an ESG fund. And I think that's one of the concerns a lot of people have. It's not just about whether it's ratings. It's about whether an investor actually says, here's an ESG fund. Go buy it because it's fantastic. And I think the data that underlies it, whether it's coming from a rating provider or it's an investor doing it, or an investment manager doing it itself for people like me, the data and the background and the description of what's in the funds, and I think, Anne, you mentioned this a bit, that the SEC is maybe looking at some of this. It does seem to be lacking, doesn't it? And that's, I think, one of the worrying things. And again, I don't think that's just an MSCI or Bloomberg or Refinitiv issue. I think that's a broader issue about how we're actually describing what an ESG fund allegedly is. So, Lynn, I'll pass it back to you.
So I think this problem is partly because of where we are actually in the development of this market, right? Because even though people cite all these impressive asset numbers, the truth is the universe of ESG funds is actually still pretty small, right? In the universe of funds, I do think it's natural that nomenclature and the naming is going to develop further as more fund options actually are offered, and then players are more motivated to kind of highlight the differentiation. Now, I think that in terms of the example that you're giving, I want to point out, I do think that there's some gap between institutional and retail investors when it comes to the level of transparency and understanding in terms of the ESG funds, because I think the institutional market has already had more access to tools to look under the hood. They can see the differences in the exposures to different E, S, and G factors in their holdings, regardless of what the fund is called. And now, their analytical tools also allow them to do performance attribution analysis to separate what's coming from ESG factors versus financial factors. So that we know that institutional investors also have typically had a stronger view or a clear view about whether they want something excluded from their portfolio. For example, they usually typically take a view on whether they want it to be excluding fossil fuels versus they want to actually be exposed fully to the energy sector, but want to take other ways to reflect their climate strategy. That's all very different and new for the retail investor and for the financial advisors that are advising retail investors. And so, what the phenomenon you're talking about, two different retail investors could have assumptions about what should or should not be in a fund that is called ESG or climate friendly or whatever it is the label. But I think that's going to improve very quickly because there's tremendous investments that are being made, I think, in investment houses and wealth managers to provide reporting on the fund's ESG profiles, right? So that you are able to see kind of what the exposure of what the holdings are actually doing, what percentage of the holdings actually are generating revenues from renewable energy or clean technologies, what's the carbon footprint of the different funds and so forth. And, for our part, we've actually put for public access the snapshots of ESG profiles for over 23,000 mutual funds and ETFs. So anyone can go up there to just understand kind of the transparency and the education of what each of these funds actually hold. I think it's going to improve.
Anthony, let me jump.
Yeah.
Let me jump in.
I'm just going to say, Tokyo, Alain, and Felipe, I want to bring you back in a second to sort of give your opinions on what you're hearing from Linda Elling and Anne. But Anne, over to you to chip in as well.
Yeah. Let me add on to that in terms of what Linda said. I think in terms of some of the work of the SEC Asset Management Committee, it goes directly to what Linda is saying in terms of the retail investors versus the institutional investors. And obviously, one of the primary missions of the SEC is the protection of retail investors who may not have the information or the sophistication, yet they are being sold these funds like you were in your 529, in your 401k. And so do they understand what's in them? Do they understand the risk profile of them? They're looking at maybe a passive investment. And in fact, some of the portfolio managers are making active decisions about what are in those passive indexes. So I think there is an obligation by the SEC to at least protect investors from to give them the information to make the decision on the investment products. But I also think the institutional investors, and wearing my old hat at CalSTRS, it took us a while to go through and really deconstruct these various indexes that we were looking at as a largely passive investor in terms of where we wanted to deploy our capital. So I think more information and transparency, as we talked before, the comparability, the consistency of the information, and the verification of the information that's coming from the companies in terms of this, because the issuers recognize that capital decisions are being made based, and capital is being deployed based on these ratings. And so they, as Linda knows, are asking for more information about how those ratings are being put together.
Thank you. I saw you put your hand up. Please do chime in. You're on mute still.
A few thoughts when I was listening to we have a big problem with the data. So that's clearly we have a big problem. And I think one of the first things we really need to have is transparency on the methodology behind the data. And that's problematic because the methodology is often proprietary intellectual property, so companies don't often give this methodology. But I think that's a first step we need to take, and if it's not given, I think the public sector will need to take it. So I'd be interested in Linda and maybe Alain's views on that. The second is that I don't think, and it's really instruments, financial instruments, the rating of instruments that is important, because in my country, for instance, the government has issued green bonds like Felipe, but we have bicycle plans and we have bicycle things and other digital things which are all environmental friendly, and we haven't increased those because we're issuing green bonds. So what you need to rate is not the instrument, but the issuer, so the government or the company. And then we get changes in behavior because we have to look whether the government is committed to changing its behavior. And maybe the third point, and that's related to these ESG scores, the data is not very good, but we don't have the luxury to wait for perfect data. So my question is, if we look not at levels, but at rates of change, so it changes in the data, would that help us a little bit overcome the problem that the levels are so different? And then finally, and that perhaps is the most important thing, ESG, or my penultimate final point, ESG has performed slightly better than the market over the past 9 months, but we don't know whether this is structural, whether it's a fluke, because there's no clear causality. It could just be because services are performing better and such like. Now, what we really need is policies to change. And so my question would be, do we expect could we give investors prospects that there's upside risk in ESG investment? Because once policies adjust, and policy will have to adjust, carbon pricing is needed. It's the only instrument that will get into all the cracks that we'll get the pricing of the externalities correct. Is it correct that once policies move, that there will be clear upside potential in the ESG sphere? Finally, certainly not for retail investors, but for institutional investors, I think we need to underscore that there's not just ESG investing, there's also voting and engagement. And I think we really need to call the investment community to perform that task at a higher level as well. Thank you.
Great, thank you. Alan, let's pass it over to you. Obviously, you earlier mentioned a lot of things that the EC has been doing. Ed also pitched over to you as an idea to sort of get your thoughts on some of the things you were saying. How do you respond to what both Ed was asking, but also what Anne and Elling were saying?
Thank you. Can you hear me?
Yes.
Hello? Okay, thank you. Well, there's a lot of what's been said that I agree with. I think we have a fundamental problem in that the data that is often going into these ratings is perhaps not as robust, reliable, and in many cases not comparable, which means that there is a problem at the sort of at the bottom of the food chain, if I can put it that way, and that is again something that we hope to address through the in Europe through the revision of the non-financial reporting directive. The use of standards has been mentioned in the introductory presentation of the report. We've not taken the Commission has not taken any formal decisions about that, but my personal opinion is that it's going to be very difficult to solve that particular problem without moving to the use of some form of common standards. There can be all sorts of debates about who should set the standards and how and so on. But in principle, I think unless we mandate common standards, it's going to be very difficult to crack that particular problem. I would also fully agree that there is a sort of a difference between credit ratings and ESG or sustainability ratings, in that, as has been said, a credit rating asks a very precise question: is what is the risk that I'm not going to get my money back? Whereas an ESG or sustainability rating can look at different aspects, and so you may have some investors who are more interested in climate risks. You may have other investors who particularly want to have sort of socially responsible or human rights focused investment, and that then you need to provide them with different kind of metrics in order to meet their particular needs. But what is important, and it's been mentioned, is ensuring an adequate level of transparency and an adequate level of governance around the methodologies and the implementation of those methodologies. That is a process we went through in the EU with the credit ratings agencies regulation that we adopted almost 10 years ago now. I'm not suggesting that we will immediately move towards regulating sustainability ratings in the same way, but there are certainly some pressures to at least move in the direction of greater transparency and in this particular area. I'm pretty skeptical about the idea that investment can just be done sort of almost on an algorithmic basis by plugging numbers into an equation, and you get the answer is 42, and that's the company that you're going to invest in, or the index that you're going to invest in. I think, as has been mentioned, sustainable or ESG focused investment requires investor engagement and is always going to require an element of judgment. But certainly there are things that we can do to make ratings more robust and certainly also more transparent.
Great, thanks, Ella, and I commend you for obviously pointing out that 42 ought to be the answer to Life, Universe, and Everything. Well done for the Hitchhiker's Guide to the Galaxy reference. Tokyo and Felipe, I'd like to bring you in on this. Start with you, Tokyo. Would you like to add some thoughts on this?
Thank you, Anthony. quite frankly, the current situation makes us very uneasy. In the report, there is a description that the high ESG rating has a positive correlation with higher carbon emission. But I would not categorically blame that this is a scam. It could happen because the data is inadequate and the methodology is not well established. So I quite agree with Mr. Sheehan or Ms. Sheehan or Mr. Hoban or Mr. Deckers that transparency and we need more verifiable data, auditable data are required, and maybe we can go for a sort of single reporting standard, common standard. But it will take time. So to me, it seems to me that the independent issue at present is whether these discrepancies are well communicated to the investors and well understood by the investors. If not, if the investors, particularly retail investors, feel that they are misguided, that will lead to the loss of confidence of the sort of sustainable investment framework itself. And then sort of a sustainable investment movement will become unsustainable. That's what I am concerned. Thank you.
That's actually exceptionally well put, Tokyo. Felipe, any thoughts from you?
Yes, thank you, Anthony. First, let me have a couple of reactions to what I've heard. The first is on the role of institutional investors. I think that we're seeing a very significant presence and a vast majority in many of the issuances of these ESGs are institutional investors, and they do have a role. And I was thinking of the idea of protecting the retail investors, and yes, I think there is a dual role here. One is the role of institutional investors. By the way, they publish research, they are very informed, they look very closely into the instruments and the issuers, and I think that they have a very important role in the market in signaling, at least in the pricing, in the research, in the things they make public. So there is, I think, a good effect of institutional investors into the retail investors, but there's also the role of regulators here. And, in terms and the quality of the information that is made public. So I think that's one other issue for this report, the fact that if you have comparable information, standardized information, which is internationally verifiable, I think that is a very important contribution to the retail investors. Let me take on a second issue, which I think was very interesting to me. The fact that Ernst said that you would have to rate more, concentrate on rating issuers rather than rating instruments. And I think this is a very provoking thought, because I would argue with a twist that you have to rate both. Practically, you have to rate the instrument and to rate the issuer. And the reason for this, I think I see several reasons. And one is the very practical thing that you have to rate whatever you are offering the market. But the issuer is important. But in order for the issuer to have an incentive to move into green and ESG, if you just are based on the rating of the issuer, the rating of the issuer will change very slowly in time. So you need to give incentive for the issuer so that the instruments are green, are social governance, so that they move into this realm, which will be a process of slow motion. It is not that, investors will take this into account, certainly both the ratings of the instrument and the issuer, but the fact that you need to provide this incentive for the issuer. Otherwise, no one would be able to jump 100% into ESG you know, in a given year or in a given issue. So I think it's a very interesting issue that was raised, and I would all this goes back to the issue of having these common standards. And I think this is another very important aspect: the standardization, the metrics, the you know, one of these intriguing facts like the correlation, the low correlation between ratings of different agencies, and the high and the positive correlation between a rating and the carbon emission, which are some of these, you know, kind of anomalies that that we need to consider. So let me stop there. Thank you.
So let me pass it back to you on that. I'm just wondering. There's a lot. Anna and others have mentioned that the need for consistency. Obviously, it comes up in the report. Given how broad the nature of data is for just environmental issues here, let alone the S and G, how possible or how consistent can data be and be useful from your perspective?
So I'm happy to address a number of things that have come up through the various comments. Specifically on the environmental piece, though, and I think that this was also in the report, I think that one of the things to be, I think, very cognizant of is that the whole topic around climate and climate risk, it can't be really, at the moment, contained under this umbrella of ESG. And that's not how it's done actually in practice either, right? Because I think that the complexity of the issues and the fact that it has to be scenario-based, it actually makes it very difficult for it to just be one of the many factors that could be under an ESG rating or model, right? So in practice, we definitely have climate risk analytics that are calculating different types of metrics that then institutional investors are using to as one of the building blocks that they would use alongside sort of ESG signals, which have, for example, more governance, right? I mean, it's just math, right? Like you only have 100 points to allocate. So you know, if you have a whole if you want climate to be much more prominent, then you need to do it alongside, or you have to actually really kind of take down the weights of the S factors or the G factors. If you don't mind, I'm just going to skip through a few of the points that the other speakers have raised. Yeah, so I think Aaron raised two points, and one is around kind of the transparency of the methodology, right? So first of all, you know, all index methodologies are public, in the public domain. I think all ratings methodologies have a more curtailed public version. I mean, as Anne said, you know, issuers engage with us very diligently, if you will, to understand actually what's in the methodologies. And I think that one of the things I just want to kind of raise for consideration is that the IP component consideration of making methodologies public is not necessarily just about the IP. It's actually also about potential room for gaming, right? Because the kinds of questions issuers start to ask are very different, you know, when they're motivated differently, right? So in terms of what it is that they want to disclose, if you do actually make it fully transparent. So I think that's a balance that I think that needs to be kind of considered when we talk about making methodologies transparent. And then the point about performance during COVID, I think that there has been a lot of attention to the performance of ESG indexes and ESG funds more generally. I think that there are better tools today to understand whether it's coming from ESG versus something else like a quality factor. And in fact, it is possible to kind of tease out what that ESG contribution is. We've looked at it with the BARA models. There's definitely a very distinct ESG factor that has contributed to the outperformance during this period. And we've looked at it across lots of different ESG indexes that have very different construction methods. So I think that has been, that's actually more transparency into or attribution into the performance that's available, and we don't have to speculate whether or not it's coming from sectors or industry, industry tilts and so on and so forth. I'm sure that's true for some funds, but that's not necessarily true for all funds. The other thing is, I know that there's a real focus on the COVID period, but actually, you can do this for a much longer history. I mean, some of these indexes and funds actually have a pretty long history before COVID, and you can see that over a longer term, the ESG is more a defensive factor, so it's not always going to be in favor. But I think these are the sort of things you can start kind of learning, and we should talk about it in that way, rather than well. I just think that there is quantitative evidence that we can look at and tools. And then I think that on the point about high ESG ratings with high carbon emissions and what Tokyo was raising. So I can't speak for the different pieces of analysis because I don't actually myself have all that data. But I feel like an important factor here is important consideration for everyone is that these things are building blocks, right? And so at the end of the day, I think most investors that we work with are actually using these things as building blocks. So if you want to build a strategy that has a strong ESG profile from an industry relative perspective, you might use the ratings, but you want your fund to have a certain carbon target or carbon emissions intensity target, or you want it to be decarbonizing over a certain period of time, you would use a different data set in order to put that into the construction methods, right? So it can't be someone commented the kind of the magic silver bullet thing. I mean, not everything can be in a rating or a score. There has to be building blocks, and I think it just needs to be clear what each of the building blocks can do for you, as an investor to meet your various investment objectives.
Great. Thank you for that. I think, as I think Greg mentioned at the beginning, as I said, you are kind of being put on the spot a bit. You, as in the ESG rating agencies, and you especially today. And I think you've given a very robust outline of how things are working. And we're coming up on time. I'm going to hand back to Greg in a minute. Just point out there are a few things that are beginning to happen on the field of data, which don't necessarily involve just governments or regulators. OS Climate, which is a non-profit group, has got together with a bunch of companies over here in the Linux Foundation to try and improve climate data. It's a very early stage. Some of the people on that panel, on that group, were on the CFTC subcommittee that recently came out with a report on climate risk in financial markets. So, I think along with what you're doing, along with what people at the CDP, SASB and others are trying to do to sort of coalesce and try and improve this, is all part, frankly, where we ought to be going. And I think where we were probably going anyway. I think it's very also fair to say, as I think Linda Ellen, you mentioned, as I think Greg mentioned, as the report mentioned, we are at a pretty early stage of this. So we are going to see a lot more developments. So look, I'm going to hand over to Greg now for the last bit. I'm going to pitch the question. He's going to field you all. And that's very simply this. What can the OECD do in the future to help push a lot of the goals that you guys have talked about, and that obviously the OECD has mentioned in its BFO report released today. With that, look, I'll be listening in a bit, but I've got to jump. I'm handing over to Greg. Thanks so much for letting me participate. It's been great. Thank you very much.
Thank you, Anthony. So who would like to respond to that one? So I think just to that question, part of it, I think, is are voluntary industry standards going to be enough to get us there? Is a question on what could be done. So whether anyone would like to comment on that question, because we do have a plethora of industry standards, but it's quite fragmented at the moment. Would anyone like to respond? Yep, Alan. I can't hear you, Alan.
Sorry, I have to unmute two buttons in order to be heard, so I'd forgotten one of them. Can you hear me now?
Yep.
Okay, great, thank you. As I said before, I think from a personal point of view, I don't see how we're going to crack this nut without moving to the use of common standards in some shape or form. Now, there are, of course, a lot of questions around that. How do we do that? There are those who advocate a solution, which is a little bit what we did in the financial reporting world in the early 2000s, where everybody moves to a single set of standards. We are, I think, today very far from the situation we were in the late 90s and early 2000s, by which time the IASB, or ISC as it was called then, was pretty much the 800-pound gorilla in the market. And there was really no other solution. We have today an absolute alphabet soup of initiatives, frameworks, and new ones that pop up almost every day. So before we get to that kind of situation, I think it's going to be quite a journey. And in addition to that, I think we have to recognize, and this has already been alluded to, that different jurisdictions have set themselves different levels of ambition. And inevitably, I think that's going to have an influence on the types of information and the types of, therefore, of standards that different jurisdictions will need to look at in order to ensure that the information is the necessary information is and relevant information is conveyed to investors. The approach that our executive vice president has set out is quite clear. We do not want to fragment capital markets, so we want to build as much as possible on what is already out there. But the fact is that there's nothing we can just pick off the shelf to use, and therefore there is inevitably some work that will be necessary to synthesize and also reflect European specificities, linked also to the broader legal framework that we have in Europe already adopted, which is also going to impact the type of information that issuers will need to issue, companies more widely. If I can quickly turn to the point about the OECD's role. In my career, I've dealt with many different topics, from environmental policy to international trade to financial sector regulation. The one thing I've always admired about the OECD, well, the two things I've always admired about the OECD has been your ability to provide robust statistics on a wide range of topics. And I always, although I don't always manage to get a subscription to all the data that I would like to get from the OECD, when I can get it, it's invariably very good. And the second, I think the second point is the analytical work and the kind of laboratory of ideas that the OECD has often been able to provide in this area. Which is also something that I've always very much admired about your organization, and something I would very much be interested to see also being done in this area. Thank you.
Okay, thank you, Alan. One thing I will say on voluntary standards, the NASDAQ has their ESG disclosure guidance, and they have 30 data points, which I actually think are quite good. But when you look at their report on the take-up, it's all over the place on each of them. So I think industry standards are good, but, I think mandated is really the only way to really get a proper way forward, not fragmentation. Arndt, I wanted to ask you what your view is, and perhaps the work that we're doing.
Well, let me just say that I agree with everything that Alain just said, and I think it's very pertinent. I would go further than in the role that the OECD can play, because it's clearly a global problem and not an EU problem. So we need to move together. I think it's clear we need mandatory requirements, not industry standards. So I think there's a role for the OECD to play here, both in first instance by increasing transparency, by establishing best practices, by making lack of transparency transparent. So by, for instance, the publication you've just done, but also I would think by clarifying what a net zero emission investment framework would look like. I was surprised that there was no attention to that in the BFO, and I think that's the next level, to look at what we actually have to do to get Paris conformity. And ultimately, I think we need a standard, and a standard preferably for all the OECD countries hold each other against. Thank you. And the Committee of Financial Markets would be absolutely thrilled to play its role in exchanging views on this, exchanging expertise and canvassing the support amongst the members. Thank you.
Thank you, Arndt. Whether anyone wants to comment further on that, otherwise I'll move back to Stefan. Back to you. Stefan. Or he's frozen. Stefan, are you? I think he's frozen, actually. There you are. Stefan, over to you.
Okay, I can hear you all and see you all. Yes, I'm somewhat frozen. Look, I put my eloquent prepared notes aside. I've been scribbling desperately following the discussion. It was really fascinating. And I see that there is no shortage of ideas, tons of experience and commitment. It's safe to say that we have come some way. I have heard the clear demand from investors, boards, and clients for greater consideration of sustainability factors. I have heard, it was interesting to hear that UBS makes sustainable investing the default option for its clients. And obviously, and we've heard that all afternoon, to address this demand, financial markets require consistent data and comparable metrics and methodologies. There's tremendous potential in the markets. This discussion showed it once again. Now, the debate also leaves me somewhat slightly worried. There is almost too much sort of convergence and consensus on the political level of where we want to go. That's still the easy part. But what Anthony called the nitty-gritty about alignment, the various issues, transparency, methodology, and the gaming, I found that interesting, the danger of gaming the rules. This will obviously be important discussions, and that's still ahead of us. Perhaps just 2 points that I would like to make. This future discussion will not be pretty. It's not just technical, and that part, from I have understood, is already difficult enough, but it will also be political. We will not just say what is ESG, but we will also say what is not. And obviously, those market participants will not be very happy. And there again, I think we perhaps also need more political guidance. The coalition of finance ministers, which Switzerland is also part, finance ministers for climate action, I think does this for the climate part, but that's just one part. If we aim, the second point, if we aim at a comprehensive indicator or metric, I think we will fail. That the apples and oranges bit that Linda Ealing alluded to. Climate already, that's important for, I guess, everybody. Biodiversity for most. Gender representation on boards, perhaps for some, perhaps for others not. Is nuclear energy clean or is it not? Are we looking at levels or are we looking at trends? Should we perhaps invest in dirty funds that are committed to come clean? That would be actually a very efficient way. But at the moment, we're looking at mostly at levels. How do we weigh one issue against the other? One solution, and I don't want to give you more homework, Greg, would be something akin to the Better Life Index that the OECD put together a number of years ago, where investors would define on a scale the preference with regard to their area of importance, the building blocks that Linda mentioned. I know some of these ideas are already around. So with this, the more onerous task is now to doggedly keep on working on the politics of ESG and to translate this into alliances, provide guidance on the timing, character, and extent of necessary reform. This will be an uphill battle, but one that everybody will win in the end. On that somewhat desperately optimistic note, Many thanks to Greg and his OECD colleagues for their relentless work for putting this report together. And I hear that he and his colleagues will be exploring many of these issues, particularly in climate risk and interaction of ESG and challenges of environmental challenges in the OECD forum that will take place, OECD Forum on Green Finance and Investment, that will take place from October 6 to 9. Many thanks, finally, and in particular to the distinguished speakers and panelists for your time, for your enthusiasm and your commitment, and of course to Anthony for navigating through these complex issues. It was, for me personally, but I think for everybody, a truly rich afternoon. Thank you to you all. Continue your good work. We will depend on it. Goodbye and stay safe.
Thank you, Stefan. Thank you, everybody.
Thank you.
Thank you.
Thank you.
Ciao.
Bye-bye.
Thank you.
Bye. Bye,
Thank you, Greg. Bye-bye. Bye, Felipe.
Bye, Felipe.
Bye-bye.